All right, greetings. Good afternoon, everyone. I am very grateful to David and Anka for coordinating this Women Teach Trading Synergy event. I have highly recommended to other women in finance and trading who I want to come in and share their perspectives, because the more women that can be seen, the better we elevate the whole space so that women can see what they can be. And just close my door real quick. And I'm very happy that I actually run a business which is 50% of my analysts are women. So I have 5 on my trading desk, and I'll talk about that a little bit more. But in a nutshell, I'm very happy to be here to share my insights on market timing, volatility, sector rotation, etc. My name is Samantha LaDuc. I'm the founder of LaDucTrading.com. This website will be getting a nice overhaul very shortly, and will be better representing the core products that we offer, as well as the contributors that make it all possible. Basically, I'm kind of known as market timer. You know, mother of market timing is kind of a nickname because I'm very, very focused on client engagement. I have contributors that have been with me for a long time. Most of them started as clients, and then they got basically into a paid gig where they share their analysis. So I know the quality of their education and their trades. I have been very fortunate that I've been kind of picked up on some national media as well for making some pretty good and bold calls. And that's basically my job. So in a nutshell, I am a paid prognosticator. I absolutely predict market moves, and it is on multiple time frames, and it is across multiple asset classes. So literally chase, swing, trend, lots of asset classes. I focus very much on interest rates and dollar because they in large part make the weather, and the rate of change determines the velocity. And today was such a busy day because Powell did his presentation to the Senate Banking Committee, and this congressional hearing that is 2 days ended up being quite market moving. If it hadn't been for Powell getting to the podium and making a big pronouncement about pricing in 50 basis points into the FOMC meeting on the 22nd, we would not have had such a big dramatic drawdown, but we nonetheless did, and that was something I had predicted. So I'm very happy that it was very productive for clients, but not a lot of time to prepare for this presentation. As a result, been very focused on today's activity. So I definitely want to be available for questions, because I'm not sure where you're coming from. In other words, I might have some beginners in the group, intermediate, advanced. I don't know if you're, what your expectations are, but feel free to kind of ping me in chat and let me know what you'd like to hear from me more of, less of. But I just want to kind of get across that this work that I do is very much focused on market timing across chase, swing, and trend timeframes, anticipating volatility, which I did this morning. And again on the 16th of February. So basically, this is exactly what I do for clients. And it is across definitely the indices, but also sectors and individual stocks. I use a backdrop of macro. So I believe very much that macro policies, macroeconomic policies will lead price. And I call this my approach macro to micro. And I've been using that for many, many years before it became popular, because I could see that policy would absolutely funnel into a stock, sector, or index rotation. Case in point of late, we had China come up off the bottom in October and literally double those Chinese ADRs. It was very clear to see, and I caught it early from my live trading room, because China was basically ordering, China ordered their state banks to stem the selling in those stocks and literally to buy them. So now we've got some, reversion happening right now, and that's because the Fed is getting more hawkish. So that backdrop of Fed rate hiking regime and particular policies that happen, whether it be at the ECB or the PBOC, which is China, or especially the Bank of Japan, they will impact a lot of the liquidity that flows into the market. So I'm very much one who tracks liquidity, not just Fed liquidity, but also net buying, net selling on an intraday basis to help clients position particular levels in the market, whether they are chasing or they're swing trading or, again, trend trading. So I'm following liquidity. I'm very focused on macro backdrop of policies, especially as it impacts interest rates and dollar. And that's because I realized early that we are all bond traders. Even if you're chasing a particular technical setup, or you have an investment in your 401k, you need to know what's going on in bond land, which is meaning you need to know what's going on with interest rates. So that is where I focus. I also have a product which is called Macro Advisor Edge, run by Craig Shapiro, former client, also hedge fund manager, and he helps literally operationalize and interpret what's going on in macro land. So that's absolutely critical to what's going on in the backdrop of the market. So if you're on a 15-minute chart, you may not care so much unless you want to know what Powell said today that was so risk off, right? Market bearish. And then you would have wanted to hear that from not only his interpretation, but also mine, because that's what we're tracking. And that's what we can help clients position for. In other words, press short, right? Or, you know, you're free. You got the tailwind if you're a bull, or, you know, got a headwind. Anyway, we're interpreting that on a day-to-day basis, depending on macro event risk. And this is broken into, at least for my service, 3 products. I have a community product called, well, Community. It hangs out in Discord. It's very much kind of younger traders, maybe more on the newish set. And they are led by some very competent, caring moderators and analysts and traders. They overlap with my club offering, which is where I have my my live trading room and all of my analysis in Slack. And then we have, of course, the Edge product, which is more sophisticated. So kind of think for purposes of community, you got a lot of beginners, newerish momentum traders, and we're using primarily technical analysis to chase intraday and multi-day moves using stocks, options, futures. And this also has live streaming from 11 to 4 every day. But this is very much focused on more chasing than anything else. My focus is on more of the swing trades, right? So I'm identifying the turns, but as it relates to more meaty and durable swing trades, as well as trend trades. So this is something that I offer in my club product, and that's basically the focus of what I wanted to talk with you today. This is very much real-time market commentary. So I'm going across lots of assets, cross assets, intermarket analysis, doing lots of custom trade engagement with clients, given my highest conviction trades, my secret sauce indicators, my best, big idea trend plays. Craig offers up his macro event risk insights, like today that we had with Powell. And long story short, we have a deep bench in total of 10. And as I mentioned, 5 of them are women. So I'm very, very proud of the company that I keep, and I'm very excited about growing this team of in-house traders. And my next hire will be a woman. So if you have questions, by the way, in general, feel free to hit me up in chat. Right now, I just wanted to kind of go over, for those who aren't familiar, I have this 3-pronged approach. Community is beginner, club is intermediate, and Edge is advanced, in a nutshell. All right, so maybe you don't know, maybe you do, but I definitely have a rotation out there, and it's updated on a regular basis. So for example, I go on Bloomberg every 3 weeks, and recently, since January 5th anyway, I've been very, very focused on gold. So I will update gold, yen, and bond trade every 3 weeks on Bloomberg. It's been really hitting. It's been extremely helpful, I think, not just for my clients, but also sharing that and being accountable for that. I have a nice rotation with Sirius XM. I also have a CNBC show that's coming up in April. So I'll be on there once a week. So it's going well. Long story short, you can catch me in Market Watch, a few other places, but suffice it to say that you can also find me on Twitter. So I am on Twitter, pretty active on the macro bent, but all of my details are going to be for clients in their Slack client workspace. So just so you know, that's really very why it's a club, right? It's exclusive, and where we also come together and provide custom trade engagement for clients who are looking for better framing, risk reward using stock options, futures, etc. So that's it. My number one job is market timing and evaluate risk. I'm definitely good in a panic, which means I'm very comfortable in identifying without hyperbole, how it's going to move, where I expect to move, where price to move, and when. I have a lot of internal indicators that I can absolutely show clients that will identify the selling and buying and the breadth. So I'm pretty tireless in providing the data that corresponds with my market analysis. So it's not an opinion, it's very critical thinking, but it's also backed up with a lot of intermarket, macro, technical, quant, fundamental analysis. So that gives them peace of mind that they've got kind of the weight of the evidence to frame a trade or to defend a trade or hedge a portfolio, etc. So that's it in a nutshell. Why a stock is moving the way it does, what to trade and how to trade it. So I have a lot of market timing calls, but I thought we'd go right kind of to what's going on in the most recent market, because a lot of this that I've shown before, some people already know, some don't. But the point is, I have last year kind of elevated this move into, let me just kind of go to a landing page here. Where the heck is that? I'll find it. Hold on. Yeah, we'll just put it right there for a second. In my Slack space, there we go. Let me just get my market thoughts together. There we go. All right, so this is, for example, last year, okay? I've been here a few times, so you probably already know that as well, but I made a top prediction in January of 2022, okay, that the growth to value rotation would continue. In that, by the way, this was posted in January 1st for obviously a year in review. In that, I had expected the market would fall 20%. SPX would go from 4,800 to 3,800. We closed at 3,835. So it was a very strong bearish bet that NASDAQ outperformance would end, and it has. And by the way, I absolutely am not bullish. I do not see NASDAQ bringing us back to all-time highs. I actually believe our highs are in. So I believe all-time highs for this year, 2023, are in. I do believe that the growth to value rotation that we had very, very stunningly, right, from my summer 2020 things over paper mantra, and that bonds are done going up, that will continue, that there'll be much more focus or kind of leaning into value plays over tech, even if tech is very oversold. Cheap does not mean it's value. So I still believe that tech and bonds will have one more leg down. And I wrote a big long missive about that for clients. So I'm still of that opinion. Crude oil did hit 130 by March of 2022. My prediction in March of 2021, when it was 65, is that it would double within a year. It did by that March. Then it got suppressed. Government intervention is a very powerful thing, and it moved lower. And I said, once it breaks 93 on a monthly, it would head back down. And we have been down and staying down, and nothing's getting us up. So the big issue right now is, where do we go from here? Since we had a fabulous January effect rotation, which I also called from January 5th, rates have obviously continued to rise. Bonds have continued to fall. We have a wonderful, I believe anyway, backdrop for bears to now press. So it's one of those deals where I'm very excited about the fact that We have a lot more meat on the bone short. Oh, by the way, that's my team. This is, like I said, this will be updated, but that's my team. And we are basically collectively helping clients figure out what's next. So today, for example, it's kind of like fast forward here. Sorry, getting me a little crazy here, but frog. Okay. All right. So back on, here it is. February 2nd, I had warned, let me go back a little bit more. January 23rd, I did an interview, lead lag report with Michael Gayed, and I said this was a quote, fake breakout, fast failure. And then on February 2nd, I warned that this rally, this short covering rally that triggered the January effect would peter out on February 2nd. And then on February 16th, I wrote, it's time, brace for impact if bond bulls don't defend here. We proceeded on this day to fall about 200 points in SPY. Then we bounced right back into resistance, which had been basically the breakdown point. And then today we rolled over quite hard. So it's one of those deals where I'm still, by the way, that's the momentum rally where I warned Momo rally look to start. And then I warned Momo rally is at risk. And that was on the February 16th. So this is a rotation basically of growth to value, one of my kind of intermarket views. And this has been very, very helpful to time the petering out of the rally. So what has happened since then? Yields have continued to move much higher. Bonds have continued lower. Dollar has continued higher, and equities have continued lower. So I also went on this rant with clients that basically U.S. government debt is the stock market, and that the rest of 2023 would be this waves of inflation peaks and equity bottoms, so that it was a short the rip kind of mentality. And one of the reasons I have been on this bent has been this intermarket analysis view of NASDAQ to SPX. So this was a, very lovely, look, this 2009, all the way up to 2020 COVID, rollover, head and shoulders, we came back in. And basically this is when I warned that we would have NASDAQ underperformance. We've had some sizable bounces, but ultimately this is definitely rolling over. And this is just from the 18th, and we're coming right back down. So there's nothing really here that shows this trend is going to be defended. In fact, it has solidly broken. So that's one of the reasons why I came up with the NASDAQ underperformance call. I also feel that this is another kind of one of those technical reads, big picture on a weekly. You can see this is composite NASDAQ. We've had a crossover, even if you use a 50 and 200 back in 2001, we proceeded to fall much lower, right down into 2003. We did the same type of crossover in 2008. And you can see also when it was very long-term bullish, but here, not so much. So I'm of the opinion, still steadfast, nothing has changed. Nothing has changed with my tech underperformance, my bond underperformance calls, that this will actually roll over and we will continue to fade lower. So that's basically what's in play. And then the other part was this government debt ratio analysis that I do, which means, and I don't have a chart of that right here, that basically when we have this, the breakdown of higher yields causing debt refinancing to get much more dangerous, it creates more selling instability in the equity and bond market. So anyway, that is still working as this the higher yield regime of sticky inflation and Fed trying to fight it, they're just massively trapped. And I show clients what that looks like in regards to Fed is trapped analysis, as well as all of my dollar yield analysis, Bank of Japan analysis, which impacts greatly gold and bonds, and the correlated impact on stocks and dollar. So this is definitely still in play. So none of this has broken. Even my, basic baseline bet that 10-year would not break below 3.33. So 3.33 meant that if we broke below it, it would be a deflation impulse. Doesn't mean we can't in the future, but the point is we got down there and then bounced very, very strongly, and that resulted in this recent freak out of an inflation impulse. So basically the whole idea is that we still have a lot of event risk to higher yields, not including, right, the jolts and non-farm payrolls this week, and CPI next week, and then FOMC and Bank of Japan the following week. So we have a continuation of risk, and that includes getting above the dollar-yen 137 or Dixie 106, or now the 10-year above 4.1. So we have a lot of macro risk events which put pressure on the market, long story short. So even when the market is supported, for example, by Bank of Japan came in October, you can't see it, but this is October right here, and did three back-to-back yen intervention programs. So September 24th, October 21st, no, September 22nd, October 21st, and October 24th. And they basically initiated QE, and that helped the dollar exactly to roll over. And when the dollar rolled over in that mid-October timeframe, you know what happened to equities, right? They got bid strongly. So not only did Bank of Japan did its major yen intervention, but the Fed also floated an article in the Wall Street Journal. They were going to be, contemplating a pause, and that, erupted the animal spirits. There was also a very large $18 billion Swiss National Bank US dollar swap with the Fed. Then I had mentioned already that PBOC, which is China, had ordered state banks to stem the selling of stocks by buying them. They also initiated a lot of QE to backstop a failing commercial real estate market. Long story short, in mid-October, you had a massive infusion of liquidity. It ended up being not just Bank of Japan, but ECB, PBOC, Fed, and Bank of Japan to the tune of $1 trillion. So that's the reason why dollar rolled over, yields came back down to 3.3, and both dollar and yields popped up like a daisy at that 3.3. And now that just shows that they're diminishing returns with all of this liquidity that keeps attempting to come into the market to basically backstop it at key points. So long story short, this is basically a work in progress, of course, as it relates to timing when the market's going to roll over intraday, multi-week, multi-month. But then just recently, I also warned clients again, here it is, here we go again. And it was this morning, actually, where we had very, very surprise Powell's statement. He wasn't waiting to float some kind of rumor during a Fed blackout period coming up before FOMC on March 22nd. He just went right for it. And he said, nope, that's fine. We're going to give the green light to a 50 basis point hike, which was my baseline bet that they would have to hike 50 basis points at the upcoming. I got a lot of flack for that, and not everybody, still agrees. But the point is, I was very, very confident that the Fed is trapped. And if they didn't hike 50 basis points, it would be worse. So the fact that they've actually pulled that forward and the market is having its swoon is basically the surprise, right? They didn't wait until FOMC. They don't really like to surprise markets. They went right for it. So this is really the risk off. Now we've got the overnight session that is going to be very curious, right? Because overnight Asian session is going to have to figure out how are they going to out-hawk the Fed? They can't. They can do yen intervention, right? Yuan intervention, which is Japan and China's currency, in order to mitigate this impact of a higher for longer Fed. And once the Fed follows through with a 50 basis point hike, there isn't any reason that would preclude them from hiking another 50 basis points. So I've been of the opinion we're going to hit 6% terminal rate, which is another way of saying the peak rate. A lot of people have said no, 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 but I'm very much on that bench because of my intermarket analysis. So I'm still in this market for assessing risk, and the risk is clearly to the upside in yields. Even if the dollar doesn't take off to the upside in a big way, the fact that it holds relatively still creates foreign currency risk. And they are going to be needing to move as it relates to selling things to accumulate dollars, because that's what they need to do in order to protect their bond programs. So it's going to be very, I think, challenging, even if the dollar doesn't spike higher, for FX currency not to feel it. So in a big picture, I've got lots of levels that I use: intermarket, breadth. I can show all those to you, but I also look at quant. And right now we've got a big quant scare or quant quake, which has to do with the 0 DTEs. So yeah, as you can probably see, I am very much focused on a generalist approach to collecting a lot of data and then putting it in context, right? I scan and synthesize the macro, definitely the quant, fundamental, intermarket, sentiment. It's all in there. It's all something that I'm trying to put together, basically the narrative of where the market's going to trade next. So right now, it's not a coincidence, for example, that $1 trillion in liquidity that's entered over the past 3 months, it was worth directly about 10% in global equities and 50 basis points off of investment grade credit spreads. Now, that's not a coincidence. It really isn't. I warned about that when it was coming in October, and this just came out yesterday. I happened to tweet this. And it's also not fundamentals. So bulls are still betting that it's going to be fundamentals that bring the market up higher for longer. But then Powell just came in this morning and said, oh, well, wait a minute. We have no problem seeking higher peak for interest rates. We are absolutely prepared to speed up if necessary. So it comes down to, there's still a lot of risk in them moving their longer term interest rate dot plot, which is just, jargon for duration trades are not expecting it. Duration is something that allows companies to kind of hedge their bets as it relates to yield, and they have this safety that the Fed is more likely to cut than hike, because that's what's happened in the last 40 years. But that all broke down in April of 2022. So let me just show you what I mean by that. So this is something that I do for clients, which is one of the charts, one of many. Let's just look at this real quick. All right. There we go. All right. So just to kind of take a look, this happens to be, your 40-year bond market happens to be ZB1. You can use ZN, you can use TLT, doesn't really matter. I look at lots and lots of different views, but the point is that's a 40-year bond market that clearly broke down. When did it broke down? In April. This is the April breakdown out of a major trend line support. What else happened in April? Our yield curve went inverted, and today it is now the 2 and 10 is like -99. The 2 and 30 is like -103. We've had 1 year of yield curve inversion. So the bond has been intonating that the market, the economy will suffer in the future. Some say recession. That's not really my job, is to time a recession. That's not my job. My job is to look for risk. And right now in the equity markets and the bond markets is still very much risk off. So this just happens to kind of show how we got defended so far. This was the October massive coordinated central bank intervention. And you can see it in, again, any of your bond proxies. But we basically couldn't get back above. We came back down, we broke down. This is on a daily, by the way, this is on a weekly. And if we break below this 123 ZB, we've got more gnashing of teeth. If we also break above, and here's exactly the level I gave on Bloomberg, no joke. Last week I was on Bloomberg with an update on my gold short, and I said there'll be gnashing of teeth if we get below, this is one thing, 123 in ZB, 101 in TLT. If we get above 105.66, where did we stop today? in Dixie, 105.66. So I can be very, very, very precise technically, right? I still need a macro backdrop to give me wind in my sales. Okay. And then I do a lot of intermarket stuff, which most don't care about. But this is another thing that I had also exactly warned about. This is the dollar yen on a weekly, but same difference. This is the dollar yuan on a weekly. I said if it gets above 137, we're almost and above 7. So these are all the same trade. This above 137, this above 7 is risk off. It's also very damaging to commodities. Commodities, by the way, whether it be oil or copper or you name it, they hate higher terminal rates. And what did Fed Powell do today? He just raised the terminal rate. So we're literally right up exactly to the warning I gave in Bloomberg. And this is, if you want to see, hold on one second. This is my Twitter handle, by the way, at Samantha LaDuc. But specifically, here are my Bloomberg notes. Okay. So you can see that on the 3rd, I had posted my notes, by the way, every 3 weeks, right? I go on there and update it. So March 3rd was the last time. And here were the exact levels I gave. And literally, this is playing out, right? So this is a macro to micro call. This was today in my trading room, literally this morning. And what did we hit? Perfectly. Let me show you. SPX level of, here we go. This is SPX, right, on an hourly. And I had given the price target literally of 3983.87. We literally closed at 398671. So we tagged. I had given the same thing for the Qs, right? In my live trading room. This was yesterday, I gave the price target of 303, and today that we would come back down to 295.80. So I can do this on a chase time frame, right? And then this is obviously gold got a little bit eventful. And that was my short for Bloomberg back on the 3rd, right? I'm like, careful. We could come right back over. You can see silver is literally on this kind of weekly trend line support. So that was price target down here. So price targets for me are this kind of natural extension of risk reward. So I want very much to see certain things happen. For example, yesterday when I gave my price target intraday, I said 407.381. That's the intraday with an overshoot of 407.716. We hit it. And then we formed a evening star reversal on the hourly and rolled over. And then today we dumped. So these are all the individual price levels, but I was still of the opinion we were going to come back down here. And the same thing with the Qs, right? Qs coordinated beautifully with this trend line on a daily, with this prior resistance level, same thing. Evening star reversal right at resistance, and it came right down to support. I mean, this is just honestly not, if you're technical, you can use trend lines, moving averages, patterns, Fibonacci. It doesn't matter. It's how you interpret the market in your own language, and this is how I do mine. But the idea is for me anyway, is to identify what are the macro event risks that can get in the way, right? So hence why I warned on the 16th, just to kind of show you that again. So literally on the 16th, right here, this 41.20, I warned it's time. And we rolled over all the way down to the 200. And that wasn't really rocket science, but guess what my price target was? 393165. Literally, that had been there since, May of 2022. That wasn't a line I put in after the fact. Clients know I'm in a live trading room. It's recorded. I've got 3 live trading room moderators. Everybody can hear what I say and check it. So the point is, we obviously came down as a short. We bounced all the way into resistance, and now we're making our way back down again. So this is time frame congruence. I love to use this chase, swing, and trend time frame to do all of my analysis across indices, dollar, yen, bonds, I don't care what, even individual stocks. So for example, Tesla, this is a gorgeous, rollover pattern, spied that, it dropped, bounced right into resistance, and now it's rolling back over again. So this on a smaller time frame, might not look so interesting, but this is fabulous risk reward to size up these technical moves. Or when I was very bearish back in the August time frame, I had a very strong thesis that we were going to roll over specifically at $286, and I'll show you why in just a second. We rolled over, but my price target was 120. That's because it's monthly support. It's just, again, how I've learned to interpret some of these longer swing shorts. We bounced at 120 and we got right back into 216, which was also price target. Now that's more time. This is on a monthly and it's all compressed. You move this into a weekly and you can see it overshot before it came back in. And then it moved higher into 216 and now it's rolling over. So for me, it's a dance on different time frames. And then it starts to form a pattern. It didn't get up to the 200-day, starts to form a pattern, looks very weak. It's starting to fail underneath and then it dumps, right? And today was another kind of weak sauce day, even though most tech did pretty darn well. So my point is, this is very much the risk reward that I'm talking about in the product that I offer, which is very focused on market timing, a live trading room, and then lots of analysis. So that's the special that I kind of wanted to identify for anyone who might be interested. It's also Women's History Month. So I love the fact that Anka and Dave are doing this. But in celebration of Women's History Month, this is exceedingly important to me to get more women managing their own wealth and growing their understanding of the market in a language that they can understand. And me and really my team of 9 contributors providing any and all support that you need to get the job done, right? So maybe macro isn't your thing and you're not going to hang out so much in Craig's Slack channel, right? Maybe you are more interested in futures. Well, Sudha is our futures trader. Maybe you want to learn more about Elliott Wave. That's Rithika. Maybe you're more into gamma, which is kind of the optionality and market structure of gamma that can trigger a lot of volatility in an underlying stock. That's Tiffany. Maybe you like advanced options where you're selling, collecting premium instead of directional, which is very much what I do. Okay, so I'm much more of a directional player. But if you want that type of advanced option, education, analysis, and trade setups, then you're going to go to Archna's channel. You're interested in oil? I have a dedicated oil trader extraordinaire who is only trading oil, like literally, and his father before him. So literally, that's what Bob does. Craig, is macro, very focused on interpreting all the macro event risk and positioning. Just brilliant in the macro sense. And that is very helpful to me. Like I'm no slouch when it comes to analysis and technical setups, but the macro is very nuanced and complicated. And I've never run a hedge fund like Craig. So it's incredibly helpful that we work together. But there's more, right? So I have momentum traders and et cetera, et cetera. So we have a really great shop. So I definitely want to just encourage you, if you're interested at all in this macro to micro analysis, we have a special. It's only until the 15th and it is 3 months. You get a discount and then it goes away in 1 week. It goes away. And in fact, I'm closing membership in my club product, not community, not edge, but in my club product for the last 2 weeks of March. So it's literally a special I'm running until March 15th, and then I'm closing membership literally for the next 2 weeks. So I want to focus on clients. I want to focus on projects. I want to focus on trading. And so this is very kind of special and unique. I've actually not closed membership before. All right. So if this is of interest, you can, find a little bit more about the service on my website. But like I said, it's a little bit outdated. It doesn't represent that we have this phenomenal team. And if you are wanting to see a little bit more about my kind of market timing calls, you can definitely, go through my Twitter handle and you can see where I've identified risk or I've answered and engaged with folks about my view on particular macro risk, event risk. This is just a little bit of where I think out loud, but it's much, much more detailed for clients, and the levels of everything that I give technically are, of course, live. And then my live trading room moderator, Michael, will summarize and post, and then also serve as liaison with Archana and Rithika for any client that is wanting to kind of get more meat from me, like they have a particular trade that they're interested in, right? And they want to get me to size it up. So I'm happy to do that. It's called custom trade engagement. And I don't know very many services that do that, but the reason I run the trading room live for 2 hours is so that I am freed up in the afternoon so I can do custom trade engagement, so I can do analysis, so I can do writing, so I can, engage on Twitter, which is very helpful. It feeds my mind and also gets me some really great guest speakers for our macro to micro power hour that we do every 2 weeks. Craig and I host that. So there's a lot of value in taking a look at the positioning of macro and how it can help you set up your trades on any time frame. So that's basically why I didn't have a prepared presentation of, what technical analysis do I use, or where is inflation headed next. I can tell you anything you want to know by just asking me in chat. So I figured that might be the best thing. Okay, so this is the LaDucTrading.com/Women's History Month, and I'll post that. Leslie, thank you so much for that. Let me hit to everyone. There you go. And you can kind of see a little bit of, so they're the contributors. This is Craig, Archana. Mike is my live trading room moderator extraordinaire. He also does the market timing videos, but he also trades and educates. He came from a really big Discord, and he's an advanced options trader as well. Suda is futures. We actually have Pat. He's on his way out. He just gave his notice a little bit. He is going back to get his master's in finance at University of Miami. So I'm going to be replacing hopefully somebody really, really good like Pat, who can focus on flow. Rithika's been with me. She's awesome. And she's very much focused on the Discord community, but also in Slack for clients, posting her trade and analysis around using Elliott Wave momentum. Riley runs the Discord live streaming from 11 to 7. So the Discord product is $100 and there's no discount offered in this particular promotion. Okay. So just kind of keep that in mind, that this is only for my club membership. Edge is a different beast altogether. Okay. So Edge is where Craig and I come together, and we are focused on, let me just grab that real quick. No, that's gotta be out of here. Yeah, so this is where Craig and I come together, and we are providing for clients much more kind of pro-to-pro concierge service for investors, do-it-yourself investors, and wealth managers. Okay, so it's very focused on macro commentary, trade analysis. Definitely Discord could care less about this. So the Discord community is much more momentum. They want the technical setups, period, end of point. And there are lots of ways to do good technical analysis, but the most important thing is working with, mentors and moderators who are actively trading and who actively care about managing risk. There's no pump and dump. This is just totally focused on, what are you looking at? How are you going to place that trade? How are you going to manage that trade if it goes against you, right? And here's what we're doing. And so it's a very, very different type of engagement in our community than in others. So you're welcome to try that out for 7 days. There is a free trial. I've got nothing for my club membership for free, because you come in and you see everything. But basically, like I said, Edge is very much focused on, bigger global equities, bonds, credit markets, and we're doing just a little bit more elevated discussion around macro risk and durable trends in the swings and trends that wealth managers care about. Long story short, whether it be crypto or currencies, doesn't really matter. But I'm covering everything in the live trading room. Yes, that's true. So outlook for oil and gold. All right, so this is, let me just bring this over here real quick. And again, let me just get this over here. I'm going to show you my oil and we'll get to that real quick. That goes there. There we go. Obviously, dollar is going to make the weather on a lot of commodities, especially with a higher dollar yen and dollar yuan. But as it relates to oil outright, I don't look at this in the same way that a lot of people do. First of all, this happens to be a 2-hour chart, just for giggles, just to show you how most people are looking very myopically on a very small time frame, right? So you can see the dollar is up, and over here you can see oil is down. But that doesn't really give you any perspective, at least in my humble opinion, it doesn't. So what I like to do is I like to zoom out, okay? So I like to take that oil chart, and let's, first of all, do crude. All right, so here's crude. This just happens to be the CFDs on crude, but it's the same idea. Whether you use USO or futures, it doesn't matter. The point is I want to show you that this first and foremost was my bet from October. And I was literally here at this conference, literally. And I said that oil would move higher into 130. In fact, I can show you that chart. Literally, this was October. Check that out. So I literally have this chart from this presentation at Synergy back in October. No joke. So I did make a call that it would go to 130. All right. It would double from 65. And it was a parabola, basically, of inflation on supply chain constraints that broke with deflation from a financial crisis. That's what happened in 2008. And I was not seeing the same parallel for 2022. It was very much oil as an inflation hedge. So my whole theme was oil as an inflation hedge. Okay, so then what happened? That was the 130 print, literally 130 and a few pennies. So we pulled back. This is support. You can kind of see this 90, 96 level. So when this basically started moving higher again, I had a Market Watch interview and I said, if we don't break $93 on a monthly, then I can see 160. Well, sure enough, not too long after that interview went out, literally the Market Watch interview went out, I think like May. So we were doing really well. We were on our way, and then it pooped right through that trend line. Anyway, long story short, we broke 93. And when I said we broke 93, my baseline bet is that we could come all the way back down to 65. And then what happened? Well, election, SPR release, etc., Russia, so many things happened. But the point is it has gone range bound. So you can see this is September 2022. And here we are in March of 2023. We've gone nowhere fast, right? So if I show you on a larger time frame, let me just show you that real quick. Here we go. If I show you this on a larger time, so on a larger time frame, this is WTIC in crude. Here's that 130.50 print. We're still coming down here, right down here until, again, this is the low it's made so far is 70. We've been chopping about between 70 and 80. And I just think we're going to head right down to the 65. We better hold, otherwise we're going to come back inside. This is weak from an RSI standpoint, from a MACD standpoint, but more importantly, there's just no momentum. There's still just no momentum. It is a very suppressed vehicle. At the time, I was very bullish on oil. It was as an inflation hedge. And then, as you know, inflation has just recently kind of gotten back up and made the Fed pay attention, but it doesn't mean that the oil supply demand dynamics have changed. Really, oil is no longer an inflation hedge at all. So we basically have this sideways chop, government intervention collar, which means it can't get too high or else it gets tapped down. It gets too low and then they buy more. So there's really no action here. I jokingly say to clients, wake me when we get above 85 and then wake me again when we get above 95. So from a risk reward standpoint, I cannot see any energy in the oil patch since it broke $93 on a monthly. And in fact, my baseline bet has been it would come back down to 65, which is right here where this red arrow is. And it still hasn't. So I am a bull, but not until this gets defended, right? It's not going away. And of course, a lot has to do with China demand, they say, but China stimulus is not making a big difference over there as it relates to demand. They have some really big issues, not just demographics and their real estate, but that literally we are flying higher in yields, and this is exporting, feeding them more inflation. We have deglobalization, we have decarbonization, and that they have tons of debt. Their growth cycle is slowing. So I am not a China bull in any way, shape, or form. I am not an oil bull unless or until we can get and stay back above $93 on a monthly. So not much exciting there for you. On the gold front, we have bigger issues, which is we could have the potential. I mean, this is beyond just what has happened of late, which is gold, GLD, just as an example, right? This was my call that basically we would get from this 154 up to 164 up to 174, fill this gap. Why is it so condensed? There we go. Fill this gap down, which happened back in April. Okay, so April had a very large dump, especially in commodities, and oil and gas as well, but especially in gold. What happened? The dollar yuan took off higher. I'll show you that as well, but just kind of keep that date and keep that big bar, that big bearish engulfing bar back in April. This is the week that ended April 22nd, okay? We made it all the way back up there to fill that gap, and then we had forced selling right here. Forced selling. They wanted out. So this is very much when I see it anyway. We sell off in gold and emerging markets, Japan and China, start buying up the dollar and dollar starts rising. So that's definitely what's happening. And we've had this, again, rollover. We haven't broken 168 on GLD, but if we do, it's obviously very, very bearish, and it looks very much like we will. So now take this date right here of April 2022, and hopefully they haven't smooshed this to bits. Good, they have not. All right, so I want you to take a look right here. You see this big bar on the weekly? What's the date? See this breakout? Craig, right? Our macro advisor, Craig, literally warned on the 19th of April. Oops, it was literally 2 days before this breakout, that this looked like it was going to move higher. And I looked at the chart and I went, let's see. And sure enough, by Friday, it spiked higher. So as this breaks out, gold sold off hard. So why is gold selling off recently? Take a look. I mean, you can time this inversely with the dollar yuan, and terminal rates higher, which is the Fed, interest rate regime, is terrible for commodities. Higher dollar yuan and dollar yen is also terrible for commodities. So it's that type of correlation that I am warning can create a lot more selling in gold. So we'll get there, and I'll have to kind of update as we get there to see if we have some stabilization. I had originally thought that we were going to get some stabilization, and gold potentially could be a very nice asset class for 2023. I was hedging my bets because I wanted to see what we did at 180. But then January 5th came in, And I said, protect gold, because now that we've made it all the way back up, right? Made it all the way back up to that very key gap fill, it's time to protect. And sure enough, we've rolled over very strong, but we haven't broken 168 for GLD. And that's what I'm waiting for now. All right, that's just a little bit of a, of an overview. Happy to answer any questions if you want. For the most part, I wanted to thank, again, Anka and David for hosting this and, giving women a voice in this space of trading and finance. And I combine the two, and I've got a great team that joins me from macro to micro, right? And I have 3 products that are very much suited to help beginners to advanced, right? So beginners for the community, club for the intermediate, and edge for the advanced. Again, I run the fishing club. Very happy to engage with you in my live trading room every morning. Very happy to do custom engagement across, again, any stock, any asset class, any time frame. I'm here to help, and we'll navigate this, crazy market as it relates to also VIX suppression. So I'm not completely unaware of, by the way, a very strong, invisible hand of God type of thing as it relates to the market getting defended, right? Which is why I say brace for impact, if equity bulls don't defend here. Brace for impact if bond bulls don't defend here. Like, I can see when the risk is going to pick up to the downside. And I, of course, am watching for more intervention efforts, like, Yellen comes in today at the same time Powell is speaking. But the point is, I can still see that we have potential for central bank intervention at times. We have the dollar that may not spike higher, but as long as it stays strong, relatively speaking, then it's still going to be a headwind because FX markets or foreign currency markets are still going to be, at risk of being short on dollars. And that is cause for even more inflation and even higher USD. So this is part of this whole mantra that I keep reiterating on Fed is trapped, which many people don't really understand the concept of this, but it just means that they don't have a way out. And I have charts that I've shown for clients. It's related to US government debt, but I'm going to kind of serve to keep that kind of client facing, but just keep in mind that this is not done. So as bullish as you might read some of the pundits, and I understand some of the hope that fundamentals will get better, that company profits, for example, can withstand higher prices with higher prices. But the big picture is, if we fall below 3,600, my bet for 2023 is that we will not see higher for years. So that's my prediction. Predictions are hard. Those are mine. Good luck, bulls.